What's going on, everyone? Welcome back to the Dr. Nessim Show. I have another great guest with us today. We have Rob Greer, who is a seasoned healthcare executive with a deep expertise in optimizing physician practices and guiding them through the complexities of the healthcare landscape. As a key figure at SovDoc, Rob leverages his extensive background in healthcare private equity and strategic advisory to empower sovereign doctors. He is dedicated to helping practices unlock their full potential through financial visibility, digital transformation, and strategic advisory services. Rob's approach is rooted in enhancing profitability and maximizing practice value, all while ensuring that patient care remains uncompromised. His work is pivotal in helping practices navigate the evolving industry landscape, positioning them for long-term success and sustainability. Rob, thank you so much for coming on today.
Yeah, thanks for having me, Adam. I appreciate it, and appreciate you going through the full bio there. But
No
I'd say that's
worries.
a
Well,
pretty accurate summation of what I'm up to now. But happy to kind of double click on everything.
awesome. Yeah, no, that would be great. I mean, it was very I was glad that we connected because, I'm a physician getting out of residency soon, very interested in starting my own private practice, and it seems like that is essentially what you help physicians with, maybe a little bit farther along in their career. And I know you have a background in private equity, so can you kind of just go over a little bit more of like what your background is, how you got to this point, and started SovDoc?
Yeah, I mean, I'll do like the medium form version, but yeah, basically, I was born and raised in Bergen County, New Jersey, so not too far from you, and kind of in the sphere of the New York City area. From there, I've always wanted to be an entrepreneur. Even when I was a kid, I was like the cliche lemonade stand kind of guy, selling Pokemon cards and Yu-Gi-Oh cards in high school and stuff like that.
Nice,
But
nice.
basically, yeah, I went to school in the Northeast as well. Studied finance and international business. And then from there, I went to healthcare investment banking in Manhattan. So did the drudgery and the financial boot camp that was investment banking. Kind of tested my sanity for sure, but it was also pretty cool. Like as compensation aside, it was cool to like be able to fly like first class with CEOs of Fortune 500 healthcare companies within like 3 weeks of graduating college, for example. And understanding the IPO process and big M&A deals, kind of the kind of ones that were kind of landing in the Wall Street Journal and Yahoo Finance, and the Financial Times was pretty cool as well. And ultimately, it was the value of investment banking was one, the financial foundation. So working 80 hours a week for 2 years was essentially 4 years of typical 9 to 5 work, the equivalent
It's
of that.
like residency hours, just higher
Yeah,
paid.
I'd say it was kind of residency in a nutshell, financial residency, exactly. But it also opened up a ton of doors. So I had friends in my class that went to Harvard Law School, to venture capital, to growth equity and private equity, where I landed to becoming successful startup entrepreneurs. And so like that badge of credibility that came with investment banking was I'd say probably the biggest value. So that was the investment banking stint. I only actually did a year and a half. Conventionally, it was 2 years, but ultimately joined a healthcare private equity firm, middle market, and I'll kind of explain what that means. But they had just closed a new fund and they were looking for investment professionals like me to help deploy that capital into new companies. And so ultimately joined one in San Francisco. Middle market is basically smaller sized healthcare companies, and we were very operationally focused. So it's kind of the intersection of like consulting and investing, and like buying companies that you call assets, and actually turning them around, much like you would a real estate property, with the intent of improving them, optimizing them over the course of 3 to 5 years, and then selling it for a nice profit. Generally, 3 to 5 times the equity invested. That was kind of like what our investors were expecting. And that was like a great experience for me. One, because it allowed me to think like an investor. Two, the healthcare system is super broad. It's a quarter of GDP, and there's a lot going on there and a lot of complexity. But because it's so inefficient and because it's so large, it's also right for investment opportunities. And then also like the nature of it being operationally focused meant that it was one step removed from the entrepreneurial process for me. And so like I was coming in as like another member of the team for some of these portfolio companies after we bought them. And so one, that was valuable in terms of learning how to start a business in some cases and grow a business within the healthcare space, but then also was pretty inspiring for me seeing guys in their 30s and 40s, selling their companies for 50 million, plus. And so that was pretty much the catalyst for me ultimately becoming an entrepreneur. We invested all over the place across healthcare, other than life sciences and biotech. Didn't have PhDs on the investment team and didn't want to kind of take the binary risk that was kind of life sciences and biotech. But we were investors across EHRs to vet hospitals, medical office buildings, and senior living facilities, diagnostics and telehealth during COVID. And then we also bought a lot of doctor practices. So, multi-specialty ortho to value-based primary care, DSOs. And so developed a pretty good appreciation for how to grow healthcare companies and specifically doctor practices. And also, I would say in some ways was able to kind of speak the language of doctors in the absence of having an MD, which is immensely valuable for what I'm doing now. And so just to round it out, what I'm doing with SovDoc is short for sovereign doctor. And I would kind of characterize you as a sovereign doctor in the making. So sovereign doctor synonymous with physician
I'll take that.
entrepreneur. Yeah, no, I mean it's a compliment. But basically, in the United States, back in 2019 when I was starting in private equity, I think it was like 45 to 50% of doctors were in private practice still, so entrepreneurs. And now it's closer to one third. So it's a dying breed. And we want to help empower those doctors to stay in private practice and to thrive in private practice in a world where revenue is deflationary with tougher kind of reimbursement dynamic, but then costs are inflationary because it's one of those things where scale matters. And so the bigger private practices, the hospital backed ones, are cleaning up, and the smaller doctors are just getting destroyed, for lack of a better word. And so SovDoc is productizing the healthcare private equity growth playbooks and frameworks and applying them in a consulting capacity to private doctor practices. And so that's pretty much what we're doing now. It's a 4-month-old business, so it's still nascent, but there's a ton of demand. I think, our value proposition is resonating with doctors. We are size, specialty, and geographic agnostic. And so basically talking to any doctors and, hoping to add value for those practices.
That's awesome. Yeah, that's a great summary, and it definitely like your path. You did a lot in your young years, and it seems to all have like landed very nicely into SovDoc, the private equity world. We'll focus mostly on it sounds like you did a lot of investments, but mostly the investments in those medical practices. It sounds like you were doing dental practices as well, but that's great experience that I don't think a lot of our listeners that are physicians, medical students who want to maybe one day open their own practice get exposed to. They always hear like private equity is buying out everything and they're buying up all the doctors. So
Yep.
what would you say to kind of to that point? That may sound scary, but that may also open up an opportunity. Or there's people like you have the private equity background, but you're helping doctors make their practices more efficiently. Maybe that doesn't mean they're always selling to private equity. So what are your thoughts on that? And then also kind of what are some of the things that you see for these people that either have practices or about to start practices that are some of the mistakes that they make that make it almost impossible, like you mentioned, to compete with these larger conglomerates?
Private equity for doctors is at a minimum a polarizing subject, but for a lot a scary subject, and for good reason, right? I mean, there are abundant blow up stories of private equity firms investing in doctor practices, levering up too much with debt, and also just sacrificing patient care in the name of profitability. And that's a shame. But the reality is, those private equity firms, after that blow up story happens, they're probably going out of business too. And so there's kind of a cleansing process that happens, and that's capitalism in a nutshell. And coming from the space, I mean, I could cite endless numbers of success stories, but that's drowned out by kind of the sensationalism in the media and certainly some of the folks on Capitol Hill, the Elizabeth Warrens of the world that are kind of very anti-private equity. Certainly here in California, I'm in Los Angeles now. And yeah, so like as it pertains to private equity, one, I think like regardless of how anyone feels about it, it's safe to assume that over the next 5 years, the percentage of doctors employed by private equity firms is going to go up, and it's already a meaningful percentage. So that is going to happen no matter what. And so whether doctors want to consider it or explore it, it's safe not to. It's a good idea not to sweep it under the rug because it's going to be an increasingly prominent feature of our healthcare system in the United States. So that's just setting the table. That's certainly going to be accelerated if there's kind of a change of administration to a more kind of GOP, capitalist friendly, backdrop in the economy, which is one where private equity firms are going to, thrive in. And then, private equity as a route for liquidity for doctors that have spent decades growing their practice and trying to get cash for the equity value of their practices is a really good path worth entertaining because oftentimes they can, one, pay more for, practices versus like a hospital, for example. But then also like the right private equity firm is bringing not just capital to the table, but also strategic and operational expertise, having bought, 10 plus practices in the past. And so the worst situation for a doctor is like a physician entrepreneur that likes having their freedom and then selling to a private equity firm and then they feel like an indentured servant. That's the worst case scenario, but that doesn't have to be the case. Even if they're selling a majority of their practice, it still doesn't have to be an employee employer dynamic. It can kind of be a collaboration of equals. And then certainly, I mean, there's this other path of like, by the way, you don't have to sell your whole practice. You could sell 49% of it or less, and you're still the captain of the ship, and you're the one giving orders. And the benefit of that is like you're selling a piece of the practice. You still kind of have control. You get some capital to the balance sheet to fund the growth, and then you could also cash out a little bit too. And that's one where like the 30s, 40s, 50s doctors that still have 10 plus years of runway at practicing medicine, that kind of thing works out well. Whereas if you're like the late 60s or even 70s surgeon that's trying to plot a path to retirement, then maybe a full buyout makes sense where cash out and then you kind of have like a defined 2 to 3 year contract to kind of transition out of the practice, and then you could kind of sail off into the sunset.
Makes sense. No, it definitely makes sense. What would you say is if you were someone that's starting a practice or even had a practice but it was early on, if you were trying to set it up for efficiency? I mean, you got to see from a broad overview working in private equity,
Yeah.
what your fund was looking for and what I'm sure competitors are looking for.
Yeah.
What would make a good practice, even if a doctor wasn't going to sell it, but also if they were eventually going to sell that practice? What are you guys from the private equity side
Yeah, it's a great
looking
question.
for?
Not to like overly shill SovDoc in my company, but like having kind of purchased those kinds of doctor practices, we know what private equity firms are looking for in an asset. And so what we're doing with SovDoc is helping those doctors do those things to make them look most attractive to end buyers. And so that is, a value proposition that's resonating for sure. We are not necessarily, at least not now, in the business of taking a practice from 0 to 1. So something that you're going to consider doing after med school, which I'm actually curious for you to kind of expound upon. But like we're kind of taking a practice that already has a foundation and optimizing, fine tuning, and ultimately helping them grow. And if they want to sell to private equity or to a hospital system, kind of facilitating those transactions, much like an investment bank would. And so, kind of growing to like helping them kind of do strategic initiatives. That could also mean ASC enabling the practice, starting to leverage AI, doing more locations and adding more new surgeons and diversifying the procedure mix. So it doesn't have to mean a sale. But regardless, for any private practice doctor, I still think it's good to think about like what a liquidity event might look like, even if it's 10 years away. In terms of starting a practice, I'm not an expert there, but I think like choosing the right geography where there's going to be sufficient demand, where it's not a hyper competitive environment where you're going to get kind of squeezed out by some of the larger practices, and then also kind of like starting a practice within a broader kind of macro tailwind. So I think like the med spa space, for example, is really hot right now, and aesthetics and cosmetics is big business. There's also longevity and peptides and biohacking, and like that's going to be a huge thing over the next 5 years. Then there's also kind of the regenerative medicine, stem cell side of the economy within healthcare, and then there's also ketamine, right? And so those are just like kind of a small kind of sample size of some of the practices I'm just hearing endlessly about. And I think like if anyone going into that space, I think it's going to be kind of a rising tides lifts all boats dynamic. So kind of just some things to think through for some doctors that are kind of thinking about taking the plunge into entrepreneurship.
That's interesting. It sounds like those are more the cash-based type services. What are you seeing in terms of, well, I guess you just said that's what you're seeing more recently, but like what about on the other side, like your standard cardiology practice that takes lots of different type of insurances and Medicare? We know that it's a hard battle to win now against these bigger
Yeah.
conglomerates because, for example, we don't have site neutral payments. So a private practice cardiologist, small private practice, is not always getting reimbursed at the same rate if that same private practice was bought out by a health system, and then they are getting reimbursed at a higher rate. How are you seeing those practices are still ripe for private equity transactions as well, like the radiology practice, like your cardiology, even maybe let's say this is probably harder, but like your standard in primary care practice, or
Right.
is it more like you're seeing the plastic surgery, dermatology, aesthetic, cash based world?
Yeah, no, it's a great question. So just to comment on cash pay and then like, the non-cash pay, kind of more traditional insurance-based specialties. My co-founder is a plastic surgeon. We bought one of his companies when I was in private equity. So he is opening up the serious doors within the aesthetic space. And I'm 10 minutes away from Beverly Hills, and that's where I spend most of my time these days. So, the plastics, derms, cosmetic dental, med spas of the world here. And the cash pay is obviously quite attractive for those that own the practice, including private equity, because the cash conversion cycle is so good. Cash conversion cycle meaning you're getting cash at the time of the procedures, or in some cases, if you're a very prominent plastic surgeon, getting it 3 to 6 weeks ahead of time, which is pretty amazing, right? Like you're getting that cash and you kind of have a free 0% interest loan. Whereas, some of the other specialties where there's an RCM insurance dynamic, you're not getting that cash for a while, and you're generally not getting 100% of what you're owed.
Yeah, I was gonna
And
say
so
half
it's
the time you're not even collecting all of it.
yeah, so it's tough. And so, but at the same time, the cash pay is elective, right? And so we've been in this like kind of fairy tale economy. During COVID, there was all the money printing, and there was this backlog of elective cosmetic procedures. And I think, the aesthetic space broadly has been the beneficiary of that, 22, 23, 24. But anecdotally speaking, a lot of the aesthetics practices, even here in the Beverly Hills area, are softening from like a procedure demand standpoint. Because my thesis, or I guess my hypothesis on that, is that there was a big backlog after COVID, and that got burned out, and now it's reaching a steady state again. And so it'll be interesting to see. And also, by the way, like the economy is softening in a big way, and the Fed's going to have to cut rates soon. So it'll be interesting to see
Right.
what happens with those kind of very attractive cash pay areas. But as it pertains to kind of the reimbursement specialties, there's a value no matter what, right? Even if you're a single practitioner cardiology group, there's still a value there. It's not the value you're going to get if you're a 12 surgeon orthopedic practice with 4 locations, but there's still a value there. And so I think physicians that are considering a liquidity event or a sale should be operating under that assumption. It's just a matter of selling a story, right? When you're selling a practice, it's about articulating a story that's going to resonate with buyers. And so if you're a single practitioner cardiology group, you don't want to say, hey, I'm trying to leave right away, because they're not going to get a lot of value for the practice, since you are the walking revenue of the practice, right?
Right. There's a lot of key man risk there.
Yeah, exactly. And key man risk is, it's a word that's tossed around in private equity all the time. I think the story there is, hey, I'm willing to stay for 3 to 4 years, and we'll replace my revenue with some protege that's in his 30s or 40s. But we're going to hire other cardiologists, and we're going to do more locations. And so my practice is a good platform. That, or it's you getting bolted onto a larger cardiology group and staying the course for a few years. That is a story that might be able to get you, some value for the practice. But yeah, ortho, dental, those kind of, even, vascular, neuro, pain, like there's a lot of private equity interest in there. And so just because you have a reimbursement component doesn't mean that there's not value for your practice.
Yeah, I was gonna say that makes sense because like pain management, for example, like I'm in PM&R, physical medicine
Sure.
rehabilitation residency, and then a lot of people out of that go into either pain management or anesthesia. A lot of people go into pain management. Those are kind of the two biggest
Right.
specialties that get to pain. We also had a PM&R do sports. So I'll give you an example, and the point I was making was that there'll be some cash based stuff, right? PRP treatments, but there'll also be a lot of stuff that's just billed through workers' comp or Medicare or private insurance or whatever
Sure.
it is. So that would be kind of like a good example. If let's say we had a pain practice that was, this might be in between of what you were saying of like where you work with. It's maybe not already the 10 physician ortho group or multi-specialty, but not also like a solo provider. Let's say you have a pain practice with maybe there's 2 or 3 attending physicians, 1 or 2 PAs, 1 or 2 admin, front staff, a medical assistant. So like it's definitely not the 0 to 1. We're at 1, and now like they're going to work with you. What are some of the things that, and would that be like an example of an ideal client for you? And then what are some of the example things that
Yeah.
you would be doing with that type of practice?
Yeah, no, I mean, like we would work with anyone, even if they're a single practitioner, or all the way up to, we're talking to groups that have, 15 to 20 plus surgeons, and so there's value to be squeezed no matter what, and there's kind of fine tuning to do no matter what. With that kind of example pain practice, assuming it's single location, adding to the number of locations is really kind of low hanging fruit for sure. The more providers you could add, the more revenue potential there is, and then you're limited only by your ability to get them up to utilization. Um, and then, I mean, adding like, other specialties in the mix, right? So like a lot of ortho groups have a pain component. There's no reason why the reverse can't get done with like pain adding ortho and neuro and spine and what have you, adding a ASC, adding a ortho urgent care, adding DME, and other ancillary revenue streams. Ancillary revenue streams is a word that private equity firms like because diversification is a key theme in private
All right, I'll
equity.
keep that one in mind.
Yeah, I mean, you don't ideally want to have a practice where 100% of the revenue is derived from one individual, one key man or one key woman. If you could have a practice like this 12 surgeon orthopedic group I'm talking to, where no surgeon is more than 12% of revenue,
Right.
even if one of those surgeons, whatever, not some
Knees.
morbid example, yeah,
Yeah,
leaves,
yeah,
yeah,
exactly.
it's not gonna shoot the practice in the knee. And
Gotcha.
so yeah, and then so like in terms of what we'd be doing, it would like really the core of what we're doing is fractional CFO with a PE flavor. So what does that actually mean? A lot of these practices, even tens of millions of dollars of equity value, don't know what their EBITDA is. The value of a
Right.
practice and the value of any business for that matter is your EBITDA, which is your profitability multiplied by a multiple. And so that multiple is how many years of profitability is the buyer paying for. And so it is pretty important to understand what your EBITDA is because that's pretty much the majority of net worth for a lot of these physicians, right? And so defining what that EBITDA is part of our job. Looking at the 3 to 5 year historical picture, understanding the trends, historical trends and patterns to see what can be done today to improve the operations, telling them roughly what their practice is worth, a rough valuation range if they were to sell right now. And then the biggest thing is, this physician, this client has an idea of where they want to take the practice over the next 3 to 5 years, whether it's adding an ASC, more locations, more surgeons. But that's just like kind of a qualitative vision in your head. Let's actually kind of convert that into Excel projections and like actually help solve for it on a monthly basis. That's the private equity playbook in a nutshell. And so that's pretty much what we're offering, giving our clients the treatment they would receive if they were owned by a PE firm. But it's unique in each of the clients' cases.
Yeah, I no, I like that a lot. Now, so you're throwing around a lot of great ideas, right? Let's hire the ortho surgeon or open up another location. If you are not taking PE money at this point, like you can add on to how much you're taking out in a small business loan. Maybe you have some family and friends investors.
Sure.
And then to do that, you have to probably open up an MSO because a lot of states are not even allowed to directly invest in a private practice
Right.
unless you're a physician. So now at this point, let's say you're saying these great ideas for someone who's a little bit early on in their practice. How do they accomplish that without the capital? I mean, obviously the capital they're making, they can reinvest.
Yeah.
Or is this the point where you, like you said, maybe you sell 20, 30% to raise the money to open these other locations? Because all that sounds great, right? Let's bring on an ortho surgeon, but that salary is not going to be
Right.
inexpensive
It's not going to
by
pay
any
itself.
means,
Yeah.
right?
And
So
ideally, you kind of have,
how
yeah.
do you see that kind of playing out?
Yeah, I mean, ideally, like in that kind of scenario, you have more of an eat what you kill dynamic, where it's kind of cash light, and then they're compensated in accordance with how much revenue they bring in. But regardless, I mean, there are many different paths you could take, right? Like you can do you could do the loan, but oftentimes that's recourse, right? And that can get pretty uncomfortable for the surgeons because they're coming after your assets if it doesn't go well. You could do the friends and family, but yeah, obviously you need the MSO, and it's just a little trickier that way because it's just capital, but it's passive capital. My view is like if you're going to raise capital, you might as well get someone that's an expert that's going to be able to help operationally. And it really just comes down to risk tolerance. Do you want to take on a big loan? You get to retain the equity, but like there's also a risk there personally. Or, you could sell a minority piece of the practice. Yes, you're diluting the practice, but the whole idea with raising money is yes, you're diluting maybe from 100% down to 80%, but you're going to be richer in 5 years, even owning that 80%, because that capital came in, the PE firm came in, and you guys were able to kind of expand the practice. One thing I would say, this is a little bit of a tangent, but like the right private equity firms will understand that a practice is a business, a patient is a customer, and good patient care is good business. And so it's just a matter of finding the right private equity firm, and
I
that
like that. I might
profit,
steal that slogan.
yeah, profit,
That's it.
yeah, profit. I use it a lot actually. So if we post this, a lot of people are going to hear it for the first time. But profitability is not incompatible with patient care. You just have to find the right PE firm.
No, that's good to know. And so, like, let's say someone was using your services at SovDoc, because you kind of serve as like a private equity advisor, you're like fractional CFO, you have almost like a investment banking experience
Yeah.
too. Let's say someone was going to sell their practice. Are you acting as the investment banker for that practice, or are you bringing in like other investment bankers that to represent the sell side to all these other private equity clients?
Yeah, so we're like doing investment banking as well. And so um, the historical way of selling your practice, if you're a doctor, say, hey, I want to sell my practice, let's hire an investment banking, let's sell. And by doing that, you're leaving a lot of money on the table because usually, if you kind of take a 9 to 18 month approach of, kind of fine tuning the practice, doing some low hanging fruit initiatives to improve your profitability, you add millions of dollars of equity value, even tens of millions of dollars to the value of your practice by doing some pretty simple things that a private equity firm would. And so what we're doing is giving the doctors access to PE strategies and a playbook that otherwise would be inaccessible to them unless they went down the private equity route. And so our view is like give it at least 9 to 18 months, ideally more period of time. We could kind of come in and help you do that, and then we've built a relationship, we've built credibility with you, we've shown you our ROI, and then let us just put together your investor materials and introduce you to our network of 25 plus healthcare PE firms, and we kind of act as an investment banking advisor just from the beginning to the end.
Got it. So at that point, you are essentially doing the job of the investment bankers, but
We are
also
an investment
before,
bank, yeah.
yeah, it's an investment bank. But beforehand, you're also making sure you're getting everything in a line so that you're maximizing EBITDA and hopefully getting
Yeah, and
growth.
our incentives are aligned too, because like we'll come in as the fractional CFO, we'll help you grow. We're your ex-healthcare PE insiders and your financial SWAT team, and then from there, like we're incentivized to increase the value of your practice because then we're going to get compensated as a small percentage of your practice's value when we ultimately, help you do a transaction. So yeah, I think like the way to think about SovDoc is kind of full service growth advisory. We even have folks in our network that can, help establish an ASC, that could help establish an MSO, and even, I have various friends across the healthcare AI space that, would be more than happy to kind of talk to our clients and see where they could kind of help them integrate AI, which, obviously is a big broader revolution that's happening right now as well. And on that topic, just briefly, our view is that tech-enabled and AI-enabled practices that are embracing it now, even if it's not super moving the needle, are going to outperform and going to steal market share over the next 5 years. So I think it's good for practices to even think about AI strategy, and I would say it's going to be the norm at least by 2030 to have even a chief AI officer for some of these practices.
So what would an example of that be? Like the first thing that comes to my mind is like the new AI scribe apps that are coming out, where it's just more efficient for the physician to see more or to take. They don't have to take the notes. They have the recording going when they see the patient. The AI scribe will write their notes basically, and then they can see either patients more efficiently. Well, they can see patients more efficiently. Hopefully, have more time at the end of the day, so they're not writing notes at home, and probably can see more patients that way.
Yeah, I mean, there's so many examples. I think that's a really good one, right? Where like you have an AI listening in, and then it's real tribe transcribing audio to text and updating the EHR. So like you're really kind of removing a lot of the administrative burden of seeing patients, and with that, 2 hours a day that's freed up, that allows doctors to see more patients, right? And so like they went to medical school to see patients, not to type things into an EHR monotonously. And so their revenue goes up and their quality of life goes up. And everyone knows, physician burnout is a big problem in the United States. I think partly too, there's obviously a very pronounced physician shortage in the United States as well. And if, it's the year is 2030 and the average physician could see 3 times or 5 times or 10 times as many patients as they can now in the same amount of time, because AI has removed a lot of the administrative burden, that, is a step in the direction of relieving the physician shortage, which is going to be, a big deal for the quality of healthcare in the United States. In terms of other examples, in terms of AI, AI call center receptionist for patient scheduling and rescheduling. That already exists today, and that could seriously kind of help improve profit. AI surgical scheduling is another one. AI enabled RCM, and then obviously the more speculative things in a few years where you have kind of AI enabled Tesla Optimus robots that are helping to do surgery. I even was talking to my friend yesterday who's a plastic surgeon med spa guy in Beverly Hills, and he's getting a device that will take a head scan, a facial scan, and it'll offer personalized recommendations as to what cosmetic procedures that individual should do. And then it shows a before and after. So your face, and then your face
Interesting.
after you get
I think
Botox.
I got a targeted ad for this.
Yeah, it's amazing. It's a big thing in South Korea and Japan because they're usually ahead of the curve on aesthetics. But he's one of the first physicians in the United States to actually buy this machine, and so I'm keen to try it out at some point, maybe.
Very interesting.
Yeah,
Now, I will play devil's advocate a little bit on when you said if you own the practice still, right, and you can improve your efficiency, or you could say, you know what, I'm going to take this extra time and go home to my family.
sure.
But how about the doctors that are now still working for a big healthcare system that's RVU based, or they're working for private equity and they're just an employee essentially, and now they have the AI, so now it's not, oh, this is just going to free up more of your time to see patients, which is good, but we just expect you to see 30% more patients now. So they're not really feeling I mean, yes, it's less paperwork, so it's still more enjoyable work for sure.
Yeah.
It's seeing patients, but now it's like the private equity is just using that to maximize their profits, and the physician's not really sharing in that in the situation where it's not physician, and that's why I like, independent practice, but it's the situation where you're just hired by the private equity firm or by the major healthcare system.
Yeah, I mean, if you don't own any equity, then yeah, it's probably not a super desirable outcome for you, aside from seeing more patients and doing less paperwork. But if you're an equity owner in that practice as a physician, I think, that's going to benefit your bottom line. And if your compensation is tied to your production, that's going to benefit your bottom line as well. And so, I think, and then also it allows them to spend more time per patient. So if they're not even seeing like more quantity of patients, like the quality of the encounters is going to be higher. And so
Agreed.
that's going to
That's my
improve
hope
patient
for
care, and
that's my hope for this
that's the
technology.
Hippocratic Oath, right?
Yeah, no, absolutely. I think that would be my goal, right? It's like you get all the benefits, and let's not find ways to make these turn into negatives, right? Now we just expect more from the doctor. We're just going to have them see more patients until they're burnt out. If they're like,
Yeah.
oh, and that would be right. You're working for hopefully not a private equity firm that is just trying to only maximize profits, right? They're considering their employees, they're considering the patients,
Sure,
etc.
sure.
Um, okay, very cool. I think that.
None of this is going to
Uh,
matter anyway because there's not going to be human jobs in 20 years anyway. You might as
well,
well enjoy the ride
I
along the
think
way.
it. I think there'll still be people who want to have a face-to-face interaction with physicians, but who knows? Now they see. I saw that company like Forward came out with the. I don't know if you've seen this. It's like these like little pods that you go in, and everything's you get like blood drawn, and it's like a virtual visit, and
Yeah.
they're gonna have like kiosks at the mall, and it's like first AI doctor. We'll see where that goes.
Yeah, I mean, like AI doctor, like ChatGPT 8 in 2028, maybe everyone has a AI doctor in their pocket. And, obviously that's good for the first world, but think about the third world, right? Like, you have a smartphone, you have ChatGPT, you have an internet connection, and it could completely revolutionize the healthcare systems in some of these third world countries. There's also education, and that's a whole other topic. But, I mean, obviously people are going to think I'm crazy, but you said people want to see a physician face to face, but what about a world where, AI has accelerated science such that, most of the disease is kind of conquered in 20 years, right? Like, do you even need to go to a
That would be
hospital
great.
or, or a practice, right?
I hope that's a world we live in, for sure.
Yeah, we'll see. We'll see.
Um, okay, one more question from me, just for fun, because I think like sometimes it feels so out of reach, and people like that are listening to this that are physicians that have their own practices, like they don't really even know like what could be a multiple, like what is a
Yeah.
good EBITDA, like what makes sense for practice of five physicians, like what should the gross revenue be, the margins, and their EBITDA? I know you don't have to give like actual examples, but could you give like maybe a range of like what you should be striving for in terms of like per location revenue, or what you should be striving for in terms of like the multiples that you could get, at least in this market now? I know it changes, there's ebbs and flows in the cycle, but just curious to hear some of that because I think
Yeah, I mean the
it'll
range.
actually make it
Yeah, the range
real for some.
maybe call it 3 to 15 times. So I know that's not super helpful.
That's fair.
No, it's not super helpful, but like it really is. I mean, this might be a cop out answer, but it really is so situation dependent. It's specialty dependent. It's how big of a practice you are. It's how many locations and how many providers you have, the diversification of your revenue, and also kind of just the broader macro backdrop, right? Like, is it a frozen M&A market like it is now with 5% interest rates, or is it end of 2025 with 2% interest rates, and M&A is kind of there's a resurgence of M&A, right? It really is kind of situation dependent, but gosh, I think like in terms of revenue per location, that's specialty dependent. In terms of margins, I know plastic surgeons with 60% margins, right? That is completely out of reach for certain other kinds of specialties as well. So a little bit of a cop out answer. It's situation dependent, but that's kind of what we're coming in to do at SovDoc. Looking under the hood, looking at your current EBITDA. Valuation is very much an art rather than a science, right? And so it's like, what are the unique micro characteristics of this practice, and what would it be valued at? But then there's also the macro, which is the interest rate, the M&A environment, and what's in vogue, right? Like med spas are in vogue. DSOs, ortho, have been in vogue for a while. So case by case, but if folks are looking for an appraisal of their practice, feel free to give us a shout.
Okay, fair enough. We'll leave it vague until they work with you and you could really
Yeah,
dig in and see like the actual numbers, the industry. It does make sense. Like it could completely vary.
yeah.
Okay, very cool. So where can people find you if they are interested in working with you guys? At least getting like maybe start that process, see evaluation, because like you said, a lot of doctors don't even know what is their practice worth.
Yeah, so the best place would be sovdoc.com, SOVDOC.com. We're also on Instagram, SOV.DOC, and you can see some of the reels that we're doing. We have a podcast just like you do, Adam, and we interview physicians and physician entrepreneurs, including my co-founder, and various others. And we also have some like pretty interesting resources. So, like, we're not just here to kind of make a profit. We're here to kind of upskill doctors on the language of business and finance, and also by extension private equity. So we have various ebooks like Private Equity 101 for doctors and things like that make PE less of a black box, and you can actually kind of begin to understand it. And so give us a shout. I'm happy to kind of talk to anyone, whether you're an MD or not. You could book a call on my personal calendar directly through our website, and so happy to have any exploratory conversations.
Awesome. Well, go check them out. We'll drop the link below to wherever you are watching or listening to this. Rob, thank you so much for coming on. I feel like this was a really good, high-level and in-depth conversation on the world of private equity in healthcare, and not something that people get exposed to unless they're like going through a transaction. So super helpful, and I really appreciate it.
Yeah, always a pleasure speaking, Adam, and thank you very much for having me on. And would love to have you on ours soon. So stay tuned, folks. We're going
Absolutely.
to continue the conversation, but he's going to be talking for 80% of the time versus me.
All right. Perfect. Perfect. We'll make it happen. Thanks
Thanks,
again.
man.